Hi there folks, it's James Marlay here, co-founder of Livewire Markets, and welcome to our listed series for 2024. Today we're going to be taking a deep dive into the world of growth investing to give you a few tips on selecting the right assets and picking a few ETFs to give your portfolio a little bit of a rocket. I'm joined by Gleeson from Betashares and Sebastian Ferrando from Koda Capital. Gentlemen, welcome to the panel. Thanks very much for being here.
Thank you.
Thanks for having us.
Before we get into the nitty-gritty, Sebastian, what is growth investing? What does adding growth to a portfolio mean to you? And what are some of the pros and the cons that investors need to be aware of?
The pros and cons we'll get to later, but in terms of when you're building portfolios, each piece that goes in there needs to have a job, needs to do something. So to the extent that most people invest and put together portfolios, trying to increase their wealth or grow the value of that portfolio, growth is the key vehicle that does that, right? Bonds do a certain job, cash does another job, maybe some Aussie equities do some job around income, but in growth, particularly in today's context, it's a lot of tech, it's maybe some cybersecurity, it's this kind of stuff. But that's the job of the growth piece, is to give your portfolio a bit of juice and to get that value to creep up, particularly over the long term.
So about increasing the capital value?
Yes, yeah.
Cameron, do you want to add something to this? How do you guys as a product issuer think about growth?
That's spot on. In terms of if we think about equities as a whole, which we'd consider a growth asset, within equities, growth equities are really companies that are able to compound over time through really high or attractive return on equity. So what we mean by that is companies that have, say, rates of return on their shareholder capital of perhaps even 20%. And if you can do that compounding of equity returns over time, that's where you get that capital growth that we're talking about. The other advantage beyond that sort of wealth creation is that equities as a whole, they're a great long-term inflation hedge. Things like cash aren't really necessarily an inflation hedge. Equities do that. So if we're building long-term wealth and capital growth, growth equities are a great way to go.
And if I can, that's a really good point that Cameron made, that they compound, because traditionally what happens in value, you'll probably get a dividend. And I'm going to use the ASX as a good example. Relatively recently, probably 6 months ago, the ASX was flat for 16 years, right? But it paid you, let's call it 4%, 4.5% along the way. But it's almost certain you took that 4.5% out and you spent it. So your capital over 16 years never compounded. That's growth.
That's right.
And in terms of how much people are putting of their portfolio into growth, I guess the first point is work out what you need. Is that right? I mean, how much of people's portfolio should they be putting into these types of assets?
Look, I think so. The truth is today, growth has changed a bit. Actually, I'm interested in your view on this because I think growth has changed a lot. 20 years ago, 30 years ago, growth was very volatile. It's still pretty volatile, but it was really volatile. People were a bit scared of it. Today, companies that we consider growth companies have fortress balance sheets, tons of cash flow, real customers, real clients, massive ongoing businesses. So that the context and the way that growth looks today, I think is quite different.
Can I just get you to narrow down just in terms of like how much of people's portfolios, if we're to give people a bit of a marker?
Look, I overweight growth, so I might be a bad example, but probably, bare minimum 50% of your equity allocation should be growth. Definitely 50% of your international allocation, bare minimum 50%. But for most of my clients, it's 50% of their equity allocation, at least.
Cameron, how do you talk to investors about thinking about how much they should have in growth assets?
Yeah, well, of course, it depends on what else is in your portfolio and your objectives, of course, whether you need any income. But we took, for example, a simple case study of using really a flagship growth exposure being NASDAQ 100. We've got NDQ, our NASDAQ 100 exposure. And if you look at the characteristics of that fund versus the Australian equity market, because we say the Australian equity market is relatively cyclical or value-oriented, banks and miners, and NASDAQ is obviously very much oriented in high-quality, big US tech firms that have strong, resilient balance sheets. These are quite good complements. But we know that we can increase the weight to an exposure like the NASDAQ because its correlation with Australian equities is so low. So as an example, we looked at the case study of blending, for example, if you had 50% Australian equities and 50% in global equities, why not put 40% of that into an exposure like the NASDAQ, which is broad and global, but is dedicated to growth. And we can see that actually has really strong characteristics in terms of not necessarily increasing the volatility of your portfolio, but really improving the Sharpe ratio or the risk-adjusted returns.
Explain the Sharpe ratio for all those players at home.
Yeah, so Sharpe ratio is essentially your risk-adjusted return. So you're thinking about your excess return divided by your volatility. when we look at portfolio construction, we're not looking at individual funds or ETFs that you're putting in there. You're trying to think about the whole. What's the overall outcome? So if you've got an exposure, say, for example, a growth global equity exposure that has a low level of correlation or a low relationship with Australian equities, that works really well to bring balance overall.
Okay. It's a bit of a primer on growth, so the assets we're talking about. Let's get to the investing landscape. What's your view on the current backdrop and the outlook for growth assets? We've come off an interesting period with interest rates moving up really quickly. Cam, what's the view? What's the outlook?
Yeah, so our view is that the most likely scenario is that we will avoid a US recession, and we can sort of unpack that later. But in most markets, equity markets, if you are not in have a high probability of a recession, we tend to find that you can see sort of corrections. Say, for example, if investors think the market has got a bit ahead of itself, but you tend not to see those large bear markets. They tend to be associated with true recessions, which create an earnings recession. That's where you're really sort of concerned about the outlook for equities as a whole. So we think, as a whole, it's worth holding equities, worth holding growth equities. We're likely to see some rate cuts come through. So there's the good reason to be positive on growth equities.
Did you want to add anything to that in terms of the outlook for growth?
The other thing on the outlook for growth is just a lot of people think it's expensive. So that makes people kind of pull away, right? I had this conversation with someone recently. We were talking about how expensive things are. So we talked about, particularly NVIDIA, because that's what everybody wants to talk about. I was comparing it to REA and to WiseTech. So NVIDIA's trailing 12 months PE is 66. REA is 88, I think it was. And then WiseTech was 130 something, okay? But if you point forward and you do on the forward 12 month PE, so REA is about 70, WiseTech's still 130 something, and NVIDIA's 33. Like, I got it, that's higher than average, but it's not as crazy expensive as people think. And just to put that in context for a second, the Aussie market, ARB, who makes bull bars and car accessories, is at 33. So I asked this person, and I regularly ask myself, do you want to own cars and car parts and bull bars, or the potential future of the world? And I reckon that answer's pretty easy.
Yeah, well, we do have a lot of Toyotas that need upgrades here.
That's right, they're great bull bars.
But you know what? It's going to have a GPU in it one day too. And NVIDIA's going to make that GPU.
Just on NVIDIA, one of the big themes in the moment is concentration in US markets and NASDAQ and even the S&P 500. Does that concern you?
Look, yes and no. It concerns me because it concerns other people. If you go back and look in history, it's actually of no consequence. High concentration, low concentration, mid concentration. It's actually, in terms of forward-looking returns, it's not of consequence. But it worries me because you read about it a lot and it worries other people. So market dynamics being what they are, it can potentially have an impact.
Sebastian, let's get into some specifics.
Mm-hmm.
Where are you seeing the most attractive growth opportunities at the moment?
I mean, look, the easy answer is just in the tech space, and it's in the US, right? So it's broadly in the US, and then tech has got obviously a concentration of these names. But the truth is, look, if you go to the US, there's other potential growth areas. Healthcare is another good example. But the US is the home of the growth market. So I skew relatively heavily to the US. So you talked about 50-50 splits between Aussie and global equities. I'm nowhere near that. Look, if clients, like I said before, individual pieces do certain jobs. So Aussie equities do a great job of giving you tax-effective income. If that's what the clients need, let's put some Aussie equities in there. But if they just want growth, there's going to be next to no Aussie equities in there because over time, they tend to not deliver that much growth. But the direct answer to the question is, in the US, in tech, and then potentially outside of that, there's some healthcare stuff, and then there's some kind of transition in the energy space that's also got some growth.
Okay. And are you using specific indices? Like, are you skewing more heavily towards something like the NASDAQ, or are you looking for a broad-based US exposure? How do you implement that US equity exposure?
So broadly speaking, I try and split just between the S&P 500 and the NASDAQ, and then potential variations. So equal weight versus market weight on both of them, right? But broadly, those two indices, look, any US exposure that a client of mine's got is broadly going to be 50-50.
Mm-hmm. And what's the rationale behind choosing market weight versus equal weight? Can you explain why you would take put that differentiation in there?
The nice thing about equal weight is, look, the truth is we are a little bit concentrated. Some of these companies have got massive valuations. Some of them have moved really, really quickly. So for clients that are a little skittish, depending on what their situation is, how they feel about risk, how much they read the newspaper, how much they're reading the AFR. Look, if they're a little skittish, the equal weights are, it's a nice way to semi-hedge in to, the fast-moving water. Like you want to be in a canoe in the fast-moving water, you can hedge in with equal weight, taking away some of that potential valuation risk.
Cameron, over to you. What are some of the growth levers that Betashares has developed? What are some of the options that you've put on the table?
Yeah, so we talked a little bit about NASDAQ 100, which is clearly sort of core quality growth exposure. Now it's evolved to become that. Beyond that, we're looking at companies with really strong free cash flows. So global exposure with strong free cash flows will likely do very well, and it indeed has done for some period of time. Other areas where we're sort of seeing maybe interest beyond the obvious winners from AI, cybersecurity is a really strong one. That industry itself is really built for AI technology and what that can bring. And also robotics. So the industrialization, the automation of factories, we're gonna need more robots to basically build stuff as our working age population is shrinking. Clearly tailwinds from AI and what that can bring to robotics technologies. So there's some areas sort of which some of those are US aligned, but we are also seeing people look for other areas of growth that perhaps are a little bit cheaper. So Japan, for example, its equity market is growing very strongly. India is an emerging market with really strong demographics there. So we would consider that somewhat growth-oriented equities outside of the US.
Some of those opportunities you talked about seem to be thematic rather than broad indices. How do people use those ETFs versus a really broad-based ETF, like something going over the S&P 500?
Yeah, great question. Look, when we're thinking about portfolio construction, you're typically talking about, well-diversified core building blocks in the center there, and you're perhaps adding some satellite exposures. So, for example, something in cybersecurity that's going to give you, particular exposure to that thematic. Now, in terms of blending that in, we can look at, if you're using an ETF, what are the underlying holdings in that index? And just to take the example of HACK, which is our global cybersecurity ETF, there's only around about 6% weighting in cybersecurity within something like the NASDAQ. So we can see how this can be quite a good complement to what you may hold in the core, adding in a bit of diversification. So it's really about thinking about what are your correlations of your satellites, what are your holding overlap of your satellites, how can you add the potential for outperformance without, for example, increasing the weight to stocks you already hold in the core.
Yeah. We're going to talk about some specific ETFs in just a moment, but I think it's probably worth talking about the volatility that can come with holding growth assets, and the fact that high growth often means higher volatility. What steps can investors take to ride that out or prepare or insulate themselves from that volatility, or is it part of the journey?
It's a little bit part of the journey, but I think there's probably three things you can do. So one is to try that equal weight, because it'll take some of that volatility out, particularly in the S&P 500, because there's actually 503 stocks in the S&P 500, but there's obviously 7 we all know. Granted, maybe Tesla dropped out recently, it's only 6, maybe only 5 or 4, but there's a whole lot of stocks driving that index. There's a whole lot of stocks that are kind of getting taken along for the ride. To equal weight it, particularly to Cameron's point, as earnings, look, the earnings outlook is good. Stock markets over time follow one thing and one thing only, earnings. That's it. That's what they correlate to. So as the earning outlook I don't know if it improves. It's been pretty good for a while. It's still good. It looks robust. So as that remains robust, you can equal weight. So that's one way to do it. I think the other way is just good old-fashioned diversification, right? Have some bonds, have some income-producing equities, have some cash, have some alternatives, right? And then have your equities, and then diversify your equities as well. And then I think the other one is, look, when we construct portfolios, there's 3 pieces. There's the core piece, often index-based, often ETF-based, right? There's the thematic piece, which is the piece you were talking about, things like cyber and that kind of stuff. They're more tactical. And then there's the opportunistic piece. This is where you trade time and liquidity for returns in the future. So to be able to just old school diversify like that, that's a huge kind of, positive in terms of muting that volatility, right? So that you have a collection of assets that go up over time, just not at the same time.
Okay. Cameron, same question for you.
Yeah.
What are some of the ways that people can smooth out the journey?
Yep. Yeah, well, one really lucky thing we have here as Australian investors is that our Australian dollar is a risk-on currency.
Oh, yes.
What that means, right, is you can go into global equities, like global growth equities, where the best of the world's growth is, and you get a natural hedge through being basically taking a natural bet on that currency, say taking an unhedged position. So the volatility of these exposures is dampened by the fact that you're essentially translating US dollar and other currency gains and losses into Australian dollars. So that's a really good way to reduce volatility. And again, just to use an example, the Nasdaq's volatility over the last 5 years is roughly equivalent to that of the ASX. So that in itself is a clear benefit. We also sort of think about different types of equities. So we talk about growth equities, and we talked a little bit about equal weight. And indeed, for example, S&P 500 equal weight exposure, because the US equity market is a little bit growth oriented now, with the largest names being growth oriented. You could take, for example, a more cyclical approach to US equities, S&P 500 equal weight, and that will actually balance well with a more growth-oriented exposure. And so sort of bringing in different styles of investing, so value, cyclicals with growth, that really works. For a lot of investors, when you're thinking about your portfolio, if you're thinking like someone who's interested in growth, I'm likely to have a large portion of my overall portfolio in equities, right? I might have up to 90%, for example, in equities. For that defensive sleeve, say that 10% that you have left, we would think about blending in high quality fixed rate government bonds, if that is what you have left over. And the reason for that is the majority of your risk is equity risk. What risk do you need to hedge? It's that equity risk, and high quality fixed rate government bonds will ideally in times of stress be negatively correlated. So thinking about the type of defensive building block to pair with growth equities is also really important.
Okay. Well, let's get into a couple of examples of high growth, low cost ETFs. Cameron, this is your sweet spot, so I'm going to start with you. Can you bring us a few examples of the range that you have brought to market?
Of course. So one of our flagship funds is NDQ, Betashares Nasdaq 100 ETF. This fund's been in market for a number of years now, I think around about 8 years, and it has been absolutely one of the best performing ETFs or funds that you can buy or is available here in Australia. It has really evolved over time. I think we talked about its journey, and it really was, I guess, emerging companies when we first launched that ETF. These are now global stalwarts. And if you actually look at what's quite interesting, if you look at the revenue composition or where these companies earn their revenue, it's very globally diversified. So it's a good global core. We also like, as I mentioned before, companies with really strong free cash flows. So we have a fund which the ticker code for that is CFlow, which is our Betashares Global Cash Flow Kings. We think those companies are well placed and are somewhat growth oriented. And then, we talk about thematics. So cybersecurity, hack is a really strong fund that's done really well. Robotics and AI, we've got RBTZ, a strong fund that's really playing to that, I guess, industrialization of manufacturing alike. And then outside the US, thinking about Japan, we've got HJPN, which is actually a currency hedged exposure to Japanese equities. Japanese equities tend to go well when the yen depreciates. So having a currency hedge exposure works well in terms of basically hedging out the depreciation of the yen, and you get a really nice carry. You actually get about 4% per annum from that hedging activity as a tailwind. Beyond that, India, our India Quality ETF, IIND, and also Asia, which is Asian technology, somewhat unloved but relatively cheap. That's another place to look.
That's your Baidus and your Tencents and those
It's pan-Asia, so it's emerging market Asia. It's got around about a third within China. And then you've also got some of the leaders in TSMC in Taiwan and others in South Korea, India. So it covers Asia, and it's really your Asian tech titans.
Okay. Seb, finish with you.
Oh, look, probably not much to add there. The only thing I'd say, and we talked a little about this before, is that the ETF space in Australia is developing really, really nicely. But in the US, it's just there's 2,000 or 3,000 ETFs in the US you can pick from. So this is the beauty of it. To the extent that most brokerage accounts now give you a chance to pretty much buy whatever you want on any exchange you want. For people who are willing to delve a little bit into the US, almost any view that someone wants to express, particularly in the growth space, there is going to be an ETF that's very specific to what you want to do. So just don't sleep on some of those US ETFs.
What's an example of a US ETF that you can't access here that you would like to use?
So for example, you can actually slice out, there's 11 different sectors in the S&P 500, and they're all, in terms of number of companies in the S&P, roughly weighted. They're about the same. But some of them are real estate and, consumer staples and utilities, this kind of stuff. There are ETFs where you can just go and pick the sector, right? So you can build like just S&P tech, S&P healthcare, whatever it is, wherever it is you want to try and find some growth. And you can kind of make those.
You can make it a more precise.
More precise, but to Cameron's point, you can put it together with some of the other stuff. So there's a nice sort of complement. And again, two things that I love to say: all things that go up, just not all at the same time, but also each of them's got a little job, right? What's the job of that? What's the job of that? Growth, income, stability, lower my volatility, whatever it is.
Okay, I'm going to wrap things up. Final word: if you could leave people with one or two pieces of advice when they're thinking about building a high growth, low cost portfolio, what would it be?
I'd say to you, think about the core piece of the portfolio and think about the tactical thematic pieces. The core, you should think about pretty much never touching it. And to the extent you're not going to touch it, ETFs that follow an index are a wonderful way to do that.
Cameron, same question for you.
I'd add to that, just because you're using passive or rules-based ETFs, it doesn't mean you need to be passive with your investment. The big decisions are often in that asset allocation. And when we talk about building a portfolio, I think it's really important to think about those diversification benefits and think about the whole of portfolio outcome, not think about individual funds on their own. So it's really about that holistic view, which I think stands you in good stead to getting good outcomes in the long term.
It's interesting you say that. I mean, I cannot even count where I'm having a conversation with someone and I'm telling them that I'm pro ETF. They go, well, why would I do that? What do I need to hire you for? I can just do that. And I always say two things. I go, one, well, you do need to hire me because you're not doing it. So apparently you can do it, but you're not. But the second reason is, to your point, these might be passive vehicles, but they're being actively managed in terms of a portfolio, in terms of what it is a client wants, in terms of their overall balance sheet, in terms of maybe their family's overall balance sheet. So that is a very active process.
Okay. Well, thank you both for your time on the panel today.
Been a pleasure.
Anytime.
To all you viewers out there, I hope you enjoyed that session on growth investing. If you've got any questions, leave it in the comments. I'll get Cameron and Seb to respond. And remember, if you enjoyed that video, hit subscribe on the YouTube channel. We're adding fresh content every week.